definitely confident that our audience are going to get a lot of insight, especially with the whole economic uncertainty that we're all going through right now. So, Sean, we're going to start with you, and the first question is going to be around, proactive risk management. So, Sean, given your experience in real estate and oil and gas, how would you approach financial risk management in industries that are highly cynical and capital intensive?
Yeah, so thank you for that question. CFOs in cyclical industries, we must adopt multi-layered risk management approaches to mitigate financial volatility. Some of the areas that we can focus on are going to be scenario planning and stress testing by developing financial models based on different economic scenarios with regards to interest rate hikes, supply chain disruptions, and demand fluctuations. Something that comes to mind was certainly the time in 2013 where vacancy was almost zero, and then it went to 30% almost overnight. And many people were not prepared for that. Number two would be diversified capital structures, where we maintain a balance between our equity and our debt financing to ensure liquidity during downtimes. Number three would be hedging strategies, backup plans to use financial instruments like interest rate swaps, commodity hedges, or currency hedging to manage interest rate risks. Number four, operational flexibility, implement cost strategies that can be adjusted dynamically in downturns. And number five would be real-time data monitoring, where we can use leading indicators to leverage technology for predictive, analytical, and automated financial controls.
Awesome. Well, right now, you would agree with me that diversification has become the buzzword, right? In helping companies kind of like basically navigate the economic uncertainty that we are. And absolutely, diversification is a key. And so the next question now, we're going to go to Diva. Diva, as a transformational leader, how do you instill a culture of proactive risk management, within organization to ensure financial stability?
Well, thanks for the question, Eddie. We can all agree that as finance leaders, our role goes beyond managing numbers, right? We must build that culture where risk awareness is embedded in daily decision making. The first and foremost strategy I would think is aligning those risk management with your business strategy, your overall organization master plan. And that is, if you are making any financial decisions, to assess that through a risk adjusted lens, whether it's capital allocation, expansion plans, or even cost cutting measures. This means, as Sean said, using scenario planning, stress testing, that way you can anticipate all the financial risk before they materialize, and then you can be, it can help us stay ahead in terms of disruption. My second strategy, of course, the need of the hour is cash flow management. We can say that one of the most pressing concerns is the tariff uncertainty, especially in industries like manufacturing, agriculture, so on and so forth. So cash flow management becomes very critical. Maintaining a very dynamic cash flow forecasting allows us to anticipate those short-term liquidity needs and ensuring that we have the right financial buffers in place. So when we talk about cash flow management, finding that diverse funding source becomes equally important too. Whether, it's through credit facilities, you have private equity, and also the government support programs. One thing I have to say is on March 7th, the Canadian federal ministers announced all those support programs for business and workers. I definitely at this time would encourage businesses to look into that support program and utilize that to help protect against certain financial strain. And the third strategy, of course, is, again, coming in the lines of cost and management is your treasury. You want to make sure, look and relook at your, working capital structure, reduce those unnecessary costs, and then make those, not a blanket cost reduction, but a strategic cost reduction, and then manage those payment cycles. So, and beyond all these factors, the cost and funding and everything, I feel the need of the hour is also diversification. We have seen that, a company, a country too reliant on one product, one market, or even one major customer is inherently at risk. So, if we have to learn some lessons of what's happening now, expanding those revenue sources and suppliers can help business mitigate exposure to, to these downturns. So overall, if I, were to, of course, we spoke about the risk and challenges. If I were to view this risk as an opportunity, something that we should be prepared for, I would embed this proactive risk management into the daily financial strategies. That way, we're not only protecting our businesses, but we are positioning ourselves for long-term success, and then we are ready for any uncertainties.
Absolutely. You know what? I think just based on my conversation with, so many business owners as well, they're just looking for ways to reduce unnecessary cost. And I both agree with you and Sean as well. Stress testing is great. And if there's any government support that they could tap into right now, why not? Get into it so that you can keep your business in the running. For you, Mike, with your extensive experience in corporate strategy and restructuring, what are some key financial risks CFOs often overlook when navigating uncertain markets?
Right. I found, Eddie, that in terms of, let's focus on the risks that we're typically address. We're used to dealing with credit risk, whether it be our own credit and a deterioration in our financial health, how that will affect the availability of capital and help and the cost of our capital, but also on the collection side. We're used to dealing with something like that. We're also used to dealing with internal risks. At the airline, it was risks of something breaking, equipment, aircraft, particularly in the Canadian environment, which is harsh, would break. So you plan for breakage in equipment and you stockpile safety stock and in terms of spare parts on items that break. Those are the things you know about. But I think what we've learned in the last 5 to 7 years tariffs. We understand tariffs and we're afraid of tariffs. Understand that it can impact us on our sell side, our market, particularly as we're selling internationally into the United States. But we also recognize with the retaliatory tariffs that there's a potential for a very significant impact on the cost side of our business. So looking at our supply chain and having a black swan event like a domestic tariff overlaid on you, you don't think about those things in the future. We also see things that we've been introduced to in recent years, like trade restrictions and geopolitical instabilities. If, for example, your entity was dependent on the supply from, say, the Ukraine, all of a sudden your supplies dried up. So events like that are not predictable are beyond scope. And if you haven't built an organization that is prepared to pivot, then you'll pay the price. We see in the airline industry, for instance, Russia, with the sanctions that were overlaid, decided to nationalize all aircraft that were leased from by Russian airlines. Not every leasing company that held those assets. So you make sure that you can respond. And finally, there's risks and change in values. And we think of ESG and upstream producers that we're used to seeing in Calgary and oil and gas. We recognize that the change in the cultural values and the promotion of care for the environment, the codification for our desire to care for the environment has made raising equity in the markets for a period of time virtually impossible. Those are examples of things that are not the daily risks that we would normally consider as a CFO, but in retrospect and hindsight had to.
Thank you. You know what? I think my takeaway is, for business owners, CFOs, COOs, CEOs, they should be ready to build an organization that is ready to pivot at any time. So they should be ready for that. Absolutely. Well, thank you so far. Very, very insightful contributions. So the next, we're going to move over now to the cost optimization techniques. So now we're going to go back to Sean. Real estate and energy company often deal with, large capital expenditures. So what are some effective cost saving strategies CFOs in these industries can implement without stalling growth? What are some of those strategies that you think they can implement? Sean, can you please unmute?
Sorry about that.
Yeah, no worries.